Well, if you look at the euro and pound particularly, they have been sliding quite a bit from, I think, the April second week itself. We are seeing quite a downfall in this because majorly if you look at the current geopolitical situations that we have with the Middle East and also the shift towards the safe haven. So this has contributed to a bullish run into the greenback, and this is what is weighing on the euro and pound. Apart from that, if you look at the stand that has been presented by the respective central bankers, so if you look at the Fed, they have been quite hawkish on their stand, and even the data that is coming for their economic is quite hot. So considering everything, the rate cuts, which was firstly assumed to be happening in June, has been pushed back to July according to the market expectations, and that what we are seeing getting reflected into the dollar rally as well. So if you look at the current rally, it has bounced back from 102.5 something to 106.16 today, and on the contrary, we are seeing the slide because if you look at the economic numbers for Eurozone and the UK, it is not performing as much, we are seeing a very sluggish run on their economic numbers. So the central bankers there might have to take a call on the rate cut ahead of the Fed, and this is what is getting factored into their currencies as well. So I think going forward, if you look at the market expectations, we are seeing some widening happening between their central bank rates and the Fed rates, and this is what is getting factored into the prices or the momentum. So overall, the outlook will remain bearish unless there is some pickup into their economy or the cuts align with the Fed. So I don't see that happening quite soon in the near term, at least for now. And we do have a PMI numbers this week, so that will lay a further picture on how their economy is doing, and and then we'll see some momentum. But till now, I think the momentum will continue to be bearish. So for the energy sector, we were just, digesting the news from the Russia and Ukraine war. And then in October 23, we saw Israel and Hamas war situation escalating. So when this happened, it, coincided with the fall in the US crude oil inventories. As well as at the time, it was also coinciding with inflation drop down, the fast inflation drop down, which we have seen at the start of the FY23. So this was pushing forward that the rate cut will be happening quite fast. That was the picture at that time. And if you look at the first action by the Hamas, which was done, the attack that was done, it was very near to the gas field between the two countries, between the two parties, and this escalated the gas prices particularly, and then of course with the Middle East tensions, the first thing that triggers the market is the panic situation towards the disruption of the oil supply chain. So we did see some escalation on that part. So this has what resulted into the major panic situation for the energy prices. But down the line, as we are getting more accustomed to the situation, and if you look at the numbers on the demand side, it has not been so aggressive, especially from China and India. And apart from that, the rate cuts will now be held longer, considering as said, the inflation numbers and so on. So I think going forward, there will be some cool off that will happen into the which is already happening into the energy prices, and unless there is again some escalation on the Middle East part, or there is some major demand coming from the China or India, I think we'll see some sideways momentum into the crude prices. And as far as NG goes, I think it is more of a seasonal commodity, and right now we are not seeing much of the demand on that side. So more of a sideways is what I'm picturing. There is some risk to the prices on the upside especially, but we will wait if there is any escalation on that part. But unless there is, see, overall what the situation is, unless there is some impact happening on the supply chain, there will be no change into the, the oil prices. So whenever such situation happens, once there is a panic attack, that happens on the prices, and once people see the numbers that there is ample security on the inventory side, and there is no major disruption happening on the crude oil containers and the vessels, that the flows that is happening, it is still going on. So there is no disruption in the supply chain currently. So that is why we are not seeing an escalation, that the market always predicts the worst, and at that time they were like $100 the prices will come and so forth. But if you see now, it has cooled off quite a bit. So unless overall, just look at how the current geopolitical tensions are impacting the supply chain, and if there is an ample demand for the numbers, unless something or the other happens which harms these two factors, you will not see the high prices sustaining into the market. So the major factor behind the gold rally has been the aggressive buying that has been done by the central bankers. So if you look at the balance sheet of these central bankers, you'll see that China, Russia and India have been a very aggressive buyers of the gold. Apart from that, of course, when there is a geopolitical tensions, you'll see some flocking to the safe haven, and the market has drawn into that rally as well. Whether this rally is sustainable, I think my overall outlook on the gold and silver both are bullish, because like I said, by looking at the balance sheet, I think there is a gradual shift that can be seen on month, where the central bankers have been quite aggressive in increasing their gold reserve. Now the reserves also form, there are several factors that form the reserves for the central bankers. So gold is one part, foreign exchange reserve is one part, and then there is always the bonds and so forth. But the gold reserve and the foreign exchange reserve are the two major part where we see how the central bankers are acting. So here you can see that they have taken a shed of gold rather than increasing. There have been an increase on the foreign exchange, but not as much as compared to the gold. So we are seeing a gradual decline into the increased percentage on the reserve part, but gold have been quite aggressive for the central buyers. So this is the reason why I think one should remain quite bullish on the gold. There will be some rally that we are currently facing, which is more of habitual in nature, considering the 13% and so forth hike that we have seen in the prices. So whenever you see prices falling to below $23 or towards $22.50, $2200, this should be seen as more of a cooling of prices rather than a bearish trend, because right now there is nothing triggering a bearish trend into the gold prices. So I think it is more of a cool off phase rather than a bearish trend. So that will be an opportunity to accumulate into the gold who have missed on the rally. So whenever there is an inflation concern, of course, it is, negatively correlated with the prices of the precious metal, because a rise in the inflation means a rise into the interest rate or the hold off for the interest rate at current period for a longer period of time. And this means buying the commodity becomes very expensive. So, but this theory, proves kind of void when there is a geopolitical tensions into the market. So here, currently what we have seen is the same thing, where we were seeing the commodity prices also rising, gold and silver, as well as if you see the greenback strength, that is also rising. But like I said, if you look at the inflation has fallen quite a bit. It has been acting stubborn at the current rate, and this means just a hold off period for some time. But overall, I think once the market gets accustomed that the escalation will not happen much from here between the countries involved in the Middle East war situation, and they have quite digested the high interest rate. We are looking forward to the rate cuts, but market has gotten quite accustomed to it. Then the risk on sentiment shifts towards risk off, and then we see flows towards the stock market and so forth. So that is what is currently happening right now. But I think with respect to the inflation, it will not have a much major part going forward, because it has fallen quite a bit, and the rate cuts and how the economy will perform will have a major correlation with the commodity prices. For Indian rupee, I think we have fared quite a bit, as compared to the other Asian currencies. We have been quite stable thanks to the FII inflows that we have seen and the RBI timely intervention. April, I think, is the first month, where we are seeing some negative inflow, outflows that is happening. The numbers of the inflows have become negative, but overall I think RBI has maintained quite a safety net for us, and if that means that we are quite equipped in handling any violent triggers or momentum going forward, and that's what we have seen. When the dollar index is at 106, we are still at 83.37. So I think going forward there will be some underweight or factors that will be weighing on the currency, the Indian rupee, because greenback has been strengthening. There will be more timely intervention that will be needed, but I think it will be more of a stable run, and I don't see it surpassing 83.65 quite in the short term.
Right. So how are the central bank policies, particularly regarding interest rates and quantitative easing, influencing currency exchange in the major economies?
So we are currently actually into the quantitative tightening. So the policies, of course, impact the currencies because it indirectly translates into the spread between the interest rates, and we know how the inflows and outflows happens into the bond market when there is high interest rates, especially into the developed economies versus the developing economies. So I think the policy stand by the Fed will definitely shape the currency market going forward, and how the ECB and UK will act on their part, considering their economy health, whether they'll be able to take the risk on the economy and hold off the interest rate for a longer period of time to safeguard the currency, or whether they'll go for a rate cut. That will also impact what will happen into the the forex market going down the line. So I think the policy obviously does have a major stand, because we all look into the statements and so forth. So I think there will be quite a trend going, uncertainty is there into the economy, but I think Fed will not do cut rates till July, and if euro and pound go forward, then there will be some more greenback strength that could be happening into the market. Yeah.
So what are your views on the recent RBI decisions, and what would be an ideal scenario for this financial year?
So RBI has been, quite mindful in handling our policy, and they are in a, like I said, we have an ample reserve to tackle any violent, momentum into our domestic currency. And as far as policy is concerned, I think we are holding off the rates in order to just tackle the last leg of the inflation that we are seeing currently. There is some upside risk to our inflation numbers if any there is spillover from the geopolitical tensions, or there is a rise into the food inflation. But I think going forward, RBI would only do rate cut once they are comfortable with the inflation numbers, and I think I'm not seeing it happening before August or September. So until then, I think we will see a hold off into the interest rate on the RBI stand, and I think they'll continue with the stand that they have been putting forward in order to don't instigate the market towards a more risk off sentiment and create a very rate off thing with the inflation that the market has. So I think we are into a quite good place when it comes to the RBI policy and so forth, and I don't think they'll go for a rate cut beyond uh, before September or August. So inflationary pressures does happen because it makes the commodity, like I said, expensive to buy. And what investors do to hedge this is they either move to safe haven, because that is what at the time when the inflation is high. The rate cut happens, and this pushes the greenback and the safe havens on the higher side. So they flock towards a more of the investment ideas which will give them more return. So bond is something that they go forward with. And as far as hedging the commodity is concerned, I think you could always wait once the inflationary pressures have hold off, because there is a downside that happens. So either you can stand on the short side at that level, or you can just wait off and let the inflationary pressure cool off, and or wait for any demand side numbers to come in. So that way you can go forward and about into the commodity market. For currencies, obviously you can hedge in the future market and so forth. So environmental, I think it is more concerned with the energy outlook nowadays. There are different perspectives that has been, whether it is solar energy, whether it is an alternative finding to the fuel or so forth. So the world is pushing towards a green energy outlook, and this may impact the overall demand of the crude oil, but it is still a slow process, and I think there is still time, unless there is a complete shift of the major demand that the major buyers of the crude and so forth. So unless we shift towards at least 50%, we will not see much of an impact on that part. So energy, move towards environmental will definitely impact the overall demand for the crude oil prices or the natural gas and so forth down the line. In a short term, I think it is still a very slow process. As far as trade agreement goes, I think it is between the two parties which are involved, like we have with the Saudi Arabia, the FTA that we have currently developed. So, but commodity, if you take, it is a global demand that impacts. So unless there is a any impact on the global demand or global supply, a single entity, I think it will be very difficult to say will have a major impact unless they are the major importer. So if you look at the crude, major importer is first China, then India.
Yeah.
So unless something happens at the same time to all the three importers, will not see much of an impact on the prices.